Welcome back to my YouTube channel. Today we discuss option features. Another consideration is whether a security contains any option features such as conversation privilege or warrants which upon exercise allow the investor to obtain common stock. Other options include the call features which enables a company to prepay its debts, and a sinking fund provision, which allows a company to retire bonds periodically with cash payments or by buying bonds in the secondary markets. If the investors receive options, the issuing company should be able to borrow at a lower interest cost. Conversely, if the issuing company receives an option such as a call features, the investor must be compensated with a higher yield. The valuations principles behind option are complex, and complex chapter 22 covers the principles in details. Inflation, in addition to the preceding factors which affect the yield of one security relative to that of the other, inflation expectations have a substantial influence on interest rate overall. It is generally agreed that the nominal observed rate of interest on a security embodies a premium for inflation. The higher the expected inflation, the higher the nominal yield on the security, and the lower the expected inflation, the lower the nominal yield. Many years ago, Lubbock Fisher expressed the nominal rates of the interest on a bond as the sum of the real rate of interest, that is, the interest rate in the absence of the price level changes, and the rates of price changes expected to occur over the life of the instrument. If the annual real rate of the interest in the economy was 4% for low risk security, and inflation of 6% per annum was expected. Over the next 10 years, this would simply a yield of 10% for 10 years high-grade bonds. If the expected rate of inflation, not the observed or reported rate of inflation, that is added to the real rate of interest. This states merely that lenders require a nominal rate of the interest high enough for them to earn the real rate of interest after being compensated for the expected decrease in the buying power of money caused by inflation. Behavior of yield on corporate securities. Difference in default risk, marketability, maturity, taxability, and option feature affect the yield of one security relative to another at a point in time. In addition, the security yields themselves and hence the cost of funds business firms will vary over time. Fluctuations in supply and demand, pressure in financial market, as well as changing inflation expectations help explain this variability in yields. Another factor affecting the observed difference in market yields is the differential effect of taxes. The most important tax and the only one that we will consider here is income tax. The interest income on all but one category of security is taxable to taxable investment. Interest income from state and local government security is tax exempt. Therefore, state and the local issue sell in the market at lower yield to majority than treasury and the corporate security of the same maturity. For corporations located in state with income taxes, interest income on treasury security is exempt from state income tax. Therefore, such instrument may hold an advantage over the debt instrument issued by the corporations or banks because the interest they pay is fully taxable at the state level. Under present law, capital gains arising from the sale of any security at a profit are taxed at the ordinary tax rates for cooperation or at a maximum of 35%.